It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show. I'm Annabelle Drewlers with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Our top stories today, stocks across the Asia Pacific are on the up, tracking gains on Wall Street. You have optimism driven by the tech sector. You have also sentiment improving as traders add to bets for a December Fed rate cut.
Chinese President Xi Jinping and President Trump speak on the phone amid Beijing's ongoing diplomatic feud with Japan over Taiwan.
And Alibaba's going to be in focus today. The tech giant prepares to report earnings amid scrutiny over its AI investments and the price war in the food delivery space. Good morning. Welcome to the program. We're looking at a rally across risk assets, and as you can see, it's led by tech. We're up 2.5%. Taiwan is coming online. We're better by about 2.2% in the opening minutes. Japan, of course, is coming back online. It does help, of course, some of the growth-related names. Higher in duration when you look at the rates conversation with the two-year yield coming back down in the U.S. and the pricing around the Fed, which we'll get into in a moment, but effectively now at the highest, flip the page, please, the highest probability around the December meeting since the last meeting. So we're closer to 90% when you look at swaps. We're closer to 80%. Fed fund futures, 3.5%. We've taken it out to the downside. That's about a one-month low on the two-year yield. Gold futures are pushing higher. Hence, we're looking at some of the gold-related names going into the open today. Just a quick note on dollar Taiwan. That one's also been obviously on an uptrend amidst rate cut conversations. If it's going the opposite way, that might be down to the fact that you have been getting outflows out of the tech space in Korea and Taiwan. Clearly not the case today. Watch it very closely. 14-day RSI on that is at about 84 last I checked, highest since 2022. Right, the rally overnight. Golden Dragon Index, K-Web coming up. You have BABA on your screens and Hesai, which is really one of the big gainers overnight. And there is a fairly hefty premium in Hesai relative to where you are in the 8 shares. We'll get into the BABA story in a moment. Best 90% year-to-date on the share price. We could get, should be the first time actually, 1 trillion yuan on revenues annually on BABA. Earnings are coming out today. And very quickly, futures coming up, A50 both, dollar China, the 10-year yields, and just I think in the last hour or so, the PBOC coming out here with effectively more liquidity, an injection here, about 1 trillion. That's 9 straight months now, Bill, which we can get to later. But yes, we are looking at, again, the underlying conditions that have made this rally do quite well, which is obviously liquidity. So, yeah.
Yeah, liquidity, and I think if there's something that's really spurred a lot of investor appetite, it's also the Alibaba news that we had yesterday as well, because they've relaunched the Quen or the QN family essentially, and drawn a lot of downloads, a lot of interest in this space as well. And you've got those earnings coming up today, and I think that's going to be really the key thing to watch is the cloud revenue growth. And what are you seeing on that basis? Because the numbers should be pretty strong. And Morgan Stanley, for instance, is looking at what we've seen, not just in the latest quarter, where, again, you saw that strong cloud revenue growth, but going back even over the last 8 quarters. So it's the one to watch for today. But I did see the Bloomberg intelligence team is notably more bearish than pretty much anyone out there on the street. And they're saying that really don't overstate it, basically. You're continuing to see, it's misplaced, essentially. Margin pressures continue to persist for this company.
Yeah, good old Robert Lee there.
Always ready to pour a bit of cold water on the optimism.
Well, he likes to think of, he's the anchor to reality is what he calls it, right? So you have sentiment, you have fundamentals, and he...
I do think you also want to note that just because we've had JD already, but Meituan and Alibaba, that's the trio that have this big food price delivery war, and then the war around quick commerce as well. So, of course, we have seen that having a bearing.
Oh, food for thought. There we go. So key 3 themes, right? You have the earnings story, you have this injection coming through, and, of course, you have this phone call that we woke up to this morning between Chinese President Xi Jinping and U.S. President Donald Trump. Now, speaking of geopolitics here, Japanese media say that Prime Minister Sanai Takaichi and President Trump are, in fact, set to hold a phone call later. It comes after, of course, that phone call with his Chinese counterpart, Xi Jinping, held their first talk since agreeing to that tariff truce last month. Trump says the call was very good, and it touched on issues such as trade, Ukraine. He also says he will visit Beijing in April next year, and that he invited President Xi for a state visit as well going into 2026.
But I think what was really interesting was that difference that you saw between the Chinese side and also the White House, because the White House didn't, or the readout of the call didn't mention Taiwan. But at the same time, a Chinese foreign ministry statement says Xi told Trump the return of Taiwan to China is a key part of the post-World War II international order.
Yeah, well, let's get those are the facts of the case, as you will, as we present them in court. For more context here, and the interpretation, perhaps more importantly for markets, our senior Asia-Pacific geoeconomics analyst, Adam Farrar, is with us out of Washington. Adam, good morning from the Asia-Pacific. Thanks for taking the time, sir. I mean, why don't we start with, the potential risks and sort of make our way from that point. What are those potential risks if the dispute between, in this part of the world, China and Japan, continue to escalate further? What is that sort of Beijing DC prism when you look at that specific issue?
So I think there are lots of questions right now as to whether this is going to get worse. So far, we've seen China certainly expand pressure on Tokyo, starting with pretty aggressive rhetoric following Prime Minister Takaichi's comments on Taiwan on November 7th, but also escalating now into moves to slow the movement of tourists to China that bring over $13 billion a year into the Japanese economy. There are reports that Japanese media, particularly movies and music performances, are being postponed or canceled, with China being a major source of revenue for a lot of Japanese media companies. And then, of course, we've seen lots of rhetoric now from even the foreign minister really pushing Japan to fully retract what they see as statements that went too far on Taiwan and that they perceived as a threat. But the real risk here is that this escalates further. Japan relies on China as a principal trading partner, and more importantly, significantly on China's rare earths and critical minerals, which could devastate the advanced technology industry and auto industry if they were to be pulled back. But so far, right now, we're not seeing the signs that China is looking to escalate that far right now.
So then how do we interpret the call and importantly as well, the readouts of the call between Trump and Xi in the context of what's going on in Japan and between Japan and also China?
So I think up front, it was a surprise for all of us to find out that this call had happened this morning. And more importantly, it seems from everything we're seeing that actually that President Xi reached out to President Trump for the call rather than the other way around. And while certainly both sides in their readouts did highlight, ongoing conversations about implementing a complicated trade and tariff deal that has a lot of consequence for both economies, particularly on critical minerals and rare earths, as you already noted, the emphasis from President Xi on the Taiwan question in their readout, which was made available almost just minutes after acknowledgement of the call, very different from the hours that it took for President Trump to release his own statement, highlights that there was a real focus on re-baselining the Taiwan question, and particularly without mentioning Japan, emphasizing that they expect Japan and other countries in the United States, as it deals with this issue, to respect China's interest and priority on the Taiwan question and really set the bar there and try and head off anything Trump might do to escalate and push back on their pushback on Japan itself.
All right. So it's been about a month, Adam, since this tariff truce. We got a phone call overnight. We just talked about the complication between Tokyo and Beijing. What does it tell us about where U.S.-China relations go from here in terms of just being able to implement what they talked about a month back?
So far in the last couple of weeks, and even in the readout from this call and all the conversations with President Trump since the meeting in Busan, we've seen a clear upward trend in how the United States and China are talking about the relationship moving forward, right? The movement and decision to reduce tariffs by 10% and to push forward on fentanyl cooperation, opening the flow of rare earths into the U.S. economy, and pulling back on U.S. export controls and entity listings, all have set a relatively positive environment that President Trump seems to want to ride directly into this potential meeting in China in April. I think, though, there are real questions on how long that can hold. And we're already seeing some stress in the situation over soybean purchases, which China committed to massively increase compared to the almost zero it purchased this year. And the fact that those seem to be falling behind. And also just simply questions as to whether issues like Taiwan or the broader stress in the relationship on advanced technology will actually undermine this work, and whether pushback from other entities in DC, whether it be at the White House or in Congress, might actually elevate the problematic issues like Taiwan again and cause Beijing and the United States to have to renegotiate some of these deals, as we saw throughout the year with escalations followed by quick de-escalation.
Feels like I'm looking at that. Feels like an illustration of the markets up and down, which has really been very difficult to, I guess, in terms of consistency there. Adam, fantastic. Thank you so much, sir, for the context. Adam Farrar there, our senior G-economics analyst for Asia Pacific. As we were just talking about there, so on one day, hence the nature of markets, right? Up one day, down the other. But that's really been a story when you look at the last 2.5 weeks or so. You're looking at decent gains today when you look at some of the tech space here. It's been a terrible week. Of course, we're coming off the worst week for global equities, I think, going back to August. So we are getting a bounce. We'll likely get a bounce going into the open today. What's changed, too, is the nature of the Fed conversation, where that's gone from below base case. When you look at pricing, it's now closer to 90% on swaps, 80% when we look at Fed fund futures going into the December meeting. And might this be the tailwind that markets needed? Maybe it is. Winnie Wu's here with us, head of APAC equity strategy at BofA Securities. Good morning. Nice to see you.
Morning. Good to be back.
This bounce this week, who do I thank for this? Where do we send the postcard?
Well, I mean, I think market is sorting it out, right? I think, by end of October, where we were was valuation was getting a bit stretched, right? MSCI China back then was like 13.5 times PE. After the correction in November, by last Friday, we look at 12.4 times, which is slightly above the long-term average of 12, but it's actually more close to the long-term average level, not as stretched. I think, there was some year-end seasonality that people start to lock in the gains, don't make the base this year too high. And especially, this has been a great year for many investors, right? So when I was in Shanghai, some of the insurance asset managers were saying, yeah, we've done great. We don't want the base to be too high for next year, right? So there is some sort of year-end profit-taking type of behavior. But it doesn't mean that people are saying, hey, this is the end, right, that we're turning bearish for next year. So I think the general strategy we've been advising investors since the end of October is locking gains on the rallies, but you can still accumulate good stocks on the lows, right? We remain constructive for 2026, especially for the China market. And we still think that some of the structural trend like AI, like China's technology advancement is a multi-year trend that will continue to be driving the market, driving the economic growth and earning growth.
It sort of sounds like maybe it's a bit of a set and forget mentality. People sort of just want to hold into year end. I mean, that sounds more like the institutional side. It's interesting, though, because the retail crowd is maybe thinking a bit differently in terms of names like Alibaba.
Yeah, absolutely. I think, for these names, like internet names, they are very popular among retail investors, among some of the U.S. tourists, meaning like the hedge fund investors, right? Yeah. That's how they express their confidence on China's AI. Right, whereas Hong Kong, China institutional investor might play the tech hardware names like the PCBs, the optical modules, the semi chips. For overseas investor, for retail investor, it might be easier to just buy a household name like this. But we've also seen very huge volatility in the stock, because what we saw is some sort of it's a tale of two cities, right? There is the e-commerce, quick commerce challenges that the price war, the subsidy is continue to hurt the bottom line earnings and free cash flow. But on the other side, people are betting on the cloud business, the AI development. So I think very importantly, the whole focus is now, what's the plan on AI, on CapEx, on cloud, and is that really going to drive any, real productivity gain or earnings? Yeah.
What's the cleanest AI play in your view when it comes to China? Is it the platform companies, or has it also been recently, we've seen it's been a decent year for the hardware makers and the tech space, but we've also had conversations in the White House around are they not going to sell high-end chips to China, and might that be a headwind for the hardware makers? So what's your view on the cleanest AI play?
I think for now, the cleanest one is probably still the platform company. Right, that it's large, it's liquid, it's U.S. listed ADR, and on top of that, I think some overseas investors are also playing the data center names. Right. Okay. But on the other side, there is a huge supply chain of AI universe. In fact, this week last week, we just published a report.
I'm confused too, yes. Yeah. Yes, with the time, but yes.
We just published a big report, lay out 332 AI technology companies in the whole region, including 147 in China. Right, many of them are undercovered, under-researched. There's a lot of hidden gems. So that's a completely, a much bigger topic. But I would also say that from our conversation with the investor, people are more willing to spend time to look at these fundamental, some of the Asia names, some of the names focusing on the domestic localization, import substitution themes, rather than, initially I think it's the platform names, the ADRs. Then the next stage is look at the Nvidia supply chain hardware names, right? The Apple supply chain names, again, they sell to foreigners, they have strong export growth, they are certified by Nvidia, it's easy. Yeah. But I think now we're getting increasing interest for people to look at China semi-equipment names, right? To see, the localization, how quickly has it been progressing. And, in case of a global AI, US AI pullback or volatility, could these Chinese technology AI players be a diversification, right? That still get investor the exposure to the long-term AI theme, but maybe less sensitive, less exposed to the US AI capex cycle.
Winnie, stay with us because we've got a lot more to discuss with you in the moments ahead, but we'll get more from Winnie Wu, head of APAC Equity Strategy at BofA Securities in just a moment. But coming up as well, as we were discussing there, Alibaba set to report its second quarter results. Most analysts, as we've been discussing, looking at the cloud revenue growth, the expectations around that. So we're going to look at what's on tap next. But we are counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. Alibaba shares are already indicated high. We had a very strong session in ADRs overnight too. But this is the China Show. You're watching Bloomberg. Right, about 10 minutes away from the open this morning. We do have some major earnings on tap. We're wrapping up the season, but these are some that are going to be reporting later today. So we've got Pony. I think that's going to be interesting because you had WeRide actually showing some better figures. Still in the auto space, NIO, of course. Consumer, you've got Chow Tai Fook, Vitasoy, but the big one is going to be Alibaba, really. We've got those numbers coming up. And the focus very much on cloud revenue growth as well for the business. Let's get more with our Bloomberg tech reporter, Luz Ding, joining us. So, Luz, I mean, you've got a very long day ahead of you, we were just saying, but what are you going to be watching in particular with these numbers?
Yeah, so one of the key things that we'll be watching is the AI investment number that Alibaba said that they were going to invest $53 billion over the next 3 years, and that was already a huge target. And in September, they said that they're going to be beyond that, but they have not set a new target. So I'll be watching that because there are a lot of discussion about AI investment bubble, and then Alibaba has been relatively moderate in terms of that. So we'll see that. And another thing is the e-commerce. That one thing is that we want to see like how much the food delivery war has hurt the profit. And the next one is also we just passed the Double 11 shopping festival. And if they are going to release any data on that, that's always an indicator of the Chinese economy because they are one of the biggest platforms.
What about the rebrand of the AI app? Why are they doing that?
Yeah, so in terms of AI and cloud monetization, there are a lot of ways to make money out of it. Alibaba has mostly been focusing on enterprises, business targeting products, but they have not been very aggressive in terms of consumer-facing AI products. So this is to fill that gap.
What's the propensity of people to pay, do you think, on the consumer side for that?
Yeah, I'm sure, as you know as well, a proven path to monetize AI is to ask consumers to pay for a subscription, like OpenAI did with ChatGPT. But Chinese consumers are less likely. From our reporting, is less likely to pay for subscriptions like that. But Alibaba is planning to integrate a lot of other services like shopping, travel booking, mapping, and then there's a lot of other ways to monetize these products as well, potentially advertising, but we will see.
Mm-hmm. Okay, we shall. That depends on your reporting. Okay, now.
Thank you.
It's going to be fantastic. Very long day ahead there for Luz Ding, of course. Fantastic. Preview of the upcoming earnings coming through here. And as we were just showing, Alibaba's up 3%. In your pre-markets, Hesai is playing a massive catch-up to its shares overnight. It did have a decent day already, 18% overnight, 12% now. Pony AI up 11%. Also coming through in the early goings, Baidu up 4%, Xiaomi's up 3%. There's also the gold story with Zijin up about 3%. So it's a rally, not completely across the board, but in terms of market breadth, it's a decent day to be long these markets. The opening bell, 7 minutes away. A full preview is just ahead. This is the China Show. Good morning. Okay, good morning, and good morning when you look at how things are trading right now. Asia Pacific better by about, I'll be generous, 1%. Let's call it that. There we go. Half of 1% on A50 futures. We're flat on S&P. Yeah, Europe's not joining in. We'll see. We'll see what happens there. Okay, big earnings day. Lots of sectors to watch. Everything from gold to crypto to robotics and Ubitech, of course, raising some money bell and other things at play here.
Yeah, we've been crunching the numbers on Ubitech. We'll get to that in a moment. Yeah. But first up, it's that big preview to the behemoth, essentially, for earnings today, and that's going to be Alibaba that's reporting. So you're already seeing that indicated around 3% high. There's a lot of optimism around this rebranded QN model that they've launched for the consumer market. Pony AI, we've got those earnings coming out later today, but WeRide had strong numbers, and we can actually take a look at WeRide because we saw them trimming their losses. The robotaxi race, I mean, you're continuing to see that essentially gaining momentum. Baidu as well. Again, we did see a bit of nervousness essentially after their latest reporting period. Xijing Mining, you were watching on the gold story as well. But Ubitech, the story was around them essentially raising $3.1 billion from a follow-on or an offering rather of new shares. That's 98.80 a piece. Last close, you can see there. So you're looking at around a 9% discount. Hesai as well rated new outperform at CICC. But that is the China Show. The open is next. And this is Bloomberg.
Welcome back. You're watching the China Show, counting down to the open to market. It's a good day. It's a buy and dip scenario here. So we are nearing the end of the year. So no one's going to judge you if you're starting to sit percent out, booking those profits. But also if you get these dips, and I think we did bounce off the 100-day on the S&P. We closed below the 200-day on Hang Seng Tech, and I think that's one level to watch. We'll probably open above that right now given the bounce we're seeing. But yes, tech in play, and also the Fed. Live conversation around December, more than live, in fact.
Well, I think it's almost looking like a done deal at this point, as you were saying, what we're seeing indicated in futures, what we're seeing in swaps as well. You're looking at a chance of even up to 90% for the Fed to consider that cut when it comes December. But let's take a look at how the markets are opening this morning, because as you said, there's the Fed factor. There's also this rethinking of the story around tech generally, but we've seen the strong numbers today, for instance, in Taiwan coming online, Korea, Japan is back. So this is all that big tech story, but you feed into it more of the idiosyncratic factors as well. And the earnings picture that's going to take place in China today, with Alibaba really the one to watch. But you do see stocks coming online this morning, again, positivity across the board here. But let's take a look at Hong Kong in particular, because Alibaba, as we said, will be the one in focus. We've got Winnie from BofA Securities with us talking about, the institutional crowd doesn't necessarily want to have a super high benchmark to come into next year. They're happy to sort of maybe set and forget into year end. But the retail crowd continues to like names like Alibaba, especially after they've just rebranded their portfolio for consumers, essentially. But you are seeing that's their AI model portfolio, QWEN, but up 3% to come online this morning. Baidu as well, more than 4% gains so far in the session. Xiaomi, we're also keeping a watch on because the founder, Lei Jun, has raised his stake in the company to more than 23%. Xiaomi, of course, a company that is a tech giant, but they're seeing those slower smartphone sales. They did just report their earnings, and the first time we've seen profitability in the EV business unit, which is pretty exceptional when you consider they only started selling those vehicles last year. Let's shift on, take a look at some of the stocks in focus. So UbiTech is one we're watching very closely. They're looking to raise, or they have raised, $3.1 billion from a share placement. You're seeing that stock sliding here this morning, down 4%, but it was offered at 98.8 Hong Kong dollars a piece. So still quite a significant discount to the yesterday close of more than 108 Hong Kong dollars a share. Hersey Group as well, to note, we did have again those earnings coming out, and that was last week, but this week it's about CICC upgrading the stock to outperform with a pretty bullish price target as well. WeRide, another name because it's that earnings focus. We have Pony coming up later today, but WeRide, you saw them trimming their third quarter losses, and definitely that is the big theme around robotaxi companies in general in China. They're much more global than what you see from the likes of Waymo, for instance, over in the States. Jijing Mining as well, we're watching, just given the gold story, essentially, Dave.
Yeah. I think I was out. Was I out sick last week, or was it 2 weeks ago? And Hersey earnings.
It was 2 weeks ago.
It was 2 weeks ago.
Because I covered for you.
Yes, well,
I know your schedule.
Hence, I'm asking. And well, I missed that interview you guys did.
Yes,
I heard it was a good one
with David Lee. It was great.
Lee. And didn't he give out the clues on when they were opening a factory, and then he gave, was it Tom Yum Kun? He said,
Tom Yum soup. It's a country famous for Tom Yum soup, which Yvonne got in a second, Thailand, and we thought that was an interesting one, that expansion in Southeast Asia for the company. But of course, Southeast Asia, I mean, it's a really big auto manufacturing hub, and
Thailand is, yeah.
Thailand is, yeah. So that's the story there.
Yeah. That's just to say, when you look at markets this year, right, Southeast Asia's bottom of the barrel. Up there is South Korea. Japan has done fantastic. In fact, I think the statistic on Korea, it's the best year for the Kospi in about 26 years. It's really a market that's gone just berserk this year. The question is, what are the correlations looking like going into next year? And if U.S. tech blows up, what happens to that sort of ranking? Well, Winnie was here with us on set to help us understand the decision tree going into next year, head of APAC equity strategy at BofA. Okay, let's start with that premise. What if U.S. tech blows up next year?
Yeah, I think that's currently not the base case, but people start to want to think through that scenario, right? Think through what if. And in that kind of scenario, I would say that Taiwan and Korea in the region are probably the most direct derivatives of US AI, because within MSCI Taiwan is like 84% are IT sector, which is a lot of them are the AI supply chain stories. Korean, within Korea index, I think IT directly is around 40%, but there are also other industrial sectors like shipbuilding, AI defense, EV, battery names, which are also somewhat AI derivatives. And given that Korea has done so well this year, base is very high. So if the US AI has some big pullback or correction, I think Taiwan and Korean market are probably going to be the most sensitive ones to the downside. In comparison, the three larger economies, China, Japan, India, at least they have a bigger domestic economy, whether it's banks, consumption, energy, industrial. They will probably be a bit less sensitive to the global cycle and external demand. But among the three, Japan historically has very high correlation with the US market. right? And also currently investors are very bullish on Japan. That's also a consensus topic for next year under the base case scenario. But if U.S. economy or the AI cycle have a big pullback, then Japan will probably be more sensitive than India and China.
Yeah.
So in the case of U.S. AI pullback, I suspect India, among the major market, will probably be a relatively outperformer, given in the past 18 months, India was perceived as a loser in the age of AI, and India has underperformed for its domestic situations as well. I think ASEAN market, like you said, has been a loser in the age of AI and relatively under-owned, didn't have much re-rating. They will probably be the hiding place. But China is actually not badly stacked in this kind of scenario because, as I mentioned, China has a large domestic economy. China has its own AI ecosystem. The domestic localization, the technology advancement is still making progresses. And China, as of now, MSCI China PE at 12, 13 times PE in the global context is still one of the cheapest. So even in the case of an AI pullback, I would say that Taiwan, Korea, Japan will probably be more sensitive to the U.S. cycle, whereas India might be outperforming, but China is still one of the relative outperformers in the region.
Sounds like China sort of does well in either scenario.
I think so. Consider it underperformed 3 years previously.
Well, okay, so how are Chinese investors onshore? As far as risks go, are they looking domestically or are they looking to the U.S. and what happens there?
Yeah, very interesting. I was in Shanghai, Beijing in the first week of November. Investors generally have relatively low expectation on property market turning around, on consumption turnaround, on policy stimulus. So, they kind of neutral to bearish on the economy, but they are bullish on Chinese export. They say, half year after the tariff, Chinese export remain very resilient. We prove that our product really competitive, right? 30%, 50% tariff doesn't really take away the competitiveness because the products are so much cheaper. In fact, the most bullish investor was saying that, hey, if next year U.S. is going to do a lot of AI data center capex, it will be very positive for China because they need to import everything from China, from the steel, copper, to the power storage, batteries, to transformers, equipment, machinery. So that's your bull case for China. China doesn't need to do stimulus domestically. U.S. stimulus will work for China. But on the other side, talking about market risk, they also see U.S. being a key risk factor for not only the China market, but for the global market. Because for China, given people have low expectation on turnaround, on stimulus, then there's not much to disappoint, right? People are not pricing that in. But on the other side, if U.S. consumption, liquidity, AI cycle has a big reversal or downside surprise, it's probably going to be bad for global equity market. So, when we look at China, we say, okay, some investors say this year, China market, the market deviated from fundamentals. But it's not only China. You look across the world, every market was pretty much enjoying a liquidity-driven rally. And if that were to reverse, it's going to be challenging for the China market as well. So China will relatively outperform, but the absolute level might still be more challenging than this year or even last year.
So this idea that we have a sort of shock to the AI story in the US, you're saying it's not the base case. What's the probability that you are ascribing to the current themes of today, that AI conviction moving into next year?
I think we see a lot of debate on that. But my general advice would be for the next 6 months, we remain constructive. Because beyond the year-end seasonality calendar factor, looking into next year, we're hoping that liquidity perspective, Chinese insurers will have the jumpstart sales, and they will allocate 30% of the premium into the equity market. So liquidity support from southbound or from the domestic flow will be strong. There is President Trump talked about visiting China in April, and there will be market expectations on potentially some grand bargaining, big deals, stabilization in the relationship. So that should be a positive catalyst. At least investors don't want to be too bearish leading into the meeting, right? And potentially there's the Fed rate cut, U.S. liquidity easing. And if, on the U.S. side, we are still expecting the hyperscalers to grow capex very substantially. So all of that it's still quite constructive on the market, at least for the first few months of next year. Then by mid-year, I guess market need to reassess again, right? Because market will, anticipate what happens 6 months later. The midterm election is November 2027. What's the capex growth by the hyperscaler? What's their cash flow? What's their earnings? That might be a different picture. So I think, we remain constructive for the next 6 months, but we probably need to reevaluate again after second quarter next year.
All right, but at least the next few months then, in your view, seem to be pretty secure. That's Winnie Wu there joining us this morning, head of APAC equity strategy at BofA Securities. And still ahead on the China show, we're going to be digging into UBS Wealth Management's outlook for gold, commodities next year as well. They're also saying there's further room for commodity prices to run, but we'll get that outlook later with Dominic Schnider. This is Bloomberg. In some corporate news this morning, and prime office rents in Hong Kong's central business district have reportedly risen modestly in November for the first time in 3.5 years. The South China Morning Post cites JLL for its report, saying rents gained 0.1% from October. JLL told the paper that reflects how tenants in Central have been upgrading to take advantage of a soft market. Bloomberg's learned that Syngenta Group is considering an IPO in Hong Kong. This comes more than a year after it withdrew plans for a $9 billion listing in Shanghai. Sources say the Chinese-owned ag-tech company is holding preliminary talks with financial advisors and may list in Hong Kong next year. BMW is weighing the addition of range extenders to some of its electric vehicles amid growing demand for the technology popularized by its Chinese rivals. Range extenders are a small combustion engine that act as an onboard generator to recharge the battery. BMW and its German peers are trying to revive sales in China after losing market share to local rivals.
Well, yeah, speaking of, and just staying on the space here, we are watching shares of WeRide here today. We were up 10 yesterday. We're up a further 3 today. Following, of course, the numbers coming through, you have a third quarter loss, net loss that was actually, well, not as bad when you look at the comment coming out of Citi, that the 3Q loss was better than expected. Danny Lee, our transport reporter, is here with us to, put this into context. Still a loss, but not as bad.
A much improved picture. The loss is 60-odd% better, more improved than the same time previous years. So with more business, more orders coming through, and that competition generally hotting up for robotaxis, driverless fleets. There is a lot more scrutiny on these players out there, and of course for WeRide, it just recently listed in Hong Kong as well. There's a lot of competition with some of its peers very publicly, whether it's doing better or not than its peers. So yeah, there's just to see on the financial side, things pointing in the right direction is a good thing for investors and responding accordingly.
I mean, with Pony AI, of course, is the fiercest competition, even though you saw in the Baidu numbers, actually their Apollo Go divisions, again, was seeing better ride figures. But what does it look like then for the general trajectory of the business from here? Do you continue to see that expansion? Do we look for them to turn profitable in which sort of quarter? Could it be next year, do you think?
I think it does remain to be seen for now when exactly it turns profitable. But that level of competition, that fight with Pony AI, happening domestically, the partnerships it does have with the likes of Grab and Uber is a strong baseline, and also the fact that the international expansion it has, the testing that's going on in the Middle East and Europe is also important. But still, with the fact that after its listing in Hong Kong, stock has been down around 24%. Clearly the toll of that has taken the impact on the stock. But still, look, when you look ahead, there are still a lot of good fundamentals. And compared to its peers in the US, who are not doing as well, when you look at that international fight, you can see Pony AI and others fighting domestically amongst themselves. But that space internationally is a very hot one.
Yeah, and really interesting that it really is the Chinese players that are the ones that are going global, while the US ones really seem to stick more at home. But that was our Bloomberg Asia transport reporter, Danny Lee there. Thanks for joining us. And we're going to have more on China's earnings, or the earnings season ahead, including a closer look at Pony AI that's going to be reporting later today. We're going to be speaking with the head of Dun Insights, why he expects the company to focus more on its China business as it maps out a way, to profitability. More ahead. This is Bloomberg. Well, the U.S. Commerce Secretary Howard Lutnick says President Trump will decide whether to allow Nvidia to sell its more advanced H200 chips to China. Lutnick spoke with us from Brussels about the national security concerns surrounding Trump's decision.
That kind of decision sits right on the desk of Donald Trump, right? He's got Jensen from Nvidia, who really wants to sell those chips, and he's got a good reasons for it. There's an enormous number of other people who think that that's something that should be deeply considered. And the benefit that we have is we have Donald Trump in the Oval Office. He is going to weigh those decisions. He understands President Xi the best. He will decide whether we go forward with that or not. That's on his desk with lots of different advisors. The president loves to hear lots of different voices to make those kind of decisions, and he'll decide whether we sell those chips or not, and then we will go execute it however he decides to go forward.
There's a bigger question here, Secretary Lutnick, about what national security is. Is it more of a national security risk to give China some of these high-powered chips, or is it more of a national security risk to not have U.S. tech in China? Has your view on that changed?
Well, that's the question, exactly as well put and in front of the president, which is, do you want to sell China some chips and keep them using our tech and our tech stack? Or do you say to them, look, we're not going to sell you our best chips. We're just going to hold off on that, and we're going to compete in the AI race ourselves. So that is the question. It's in front of the president. He's going to decide. It's a really, really interesting question. He's got all the information. He's got lots and lots of experts talking to him, and he's going to decide which way he wants to go forward.
Secretary Lutnick, meanwhile, use of IEEPA for tariffs is in front of the Supreme Court. The feedback has been skepticism so far from many of the justices, conservative ones included. As this plays out, can you walk us through how you'd prioritize the different alternatives should the administration's use of tariffs via IEEPA get struck down?
So I was in the Supreme Court. I sat through the whole argument. The justices were tough on the beginning on the Department of Justice's, our person. But then they were much tougher on the other side, much, much tougher. So I left that day feeling very confident that we and the president was going to prevail on these IEEPA tariffs. So I think, you're hearing it from me, I think I was there in the courtroom. I heard it all the way through. I didn't sort of write my story halfway through. I sat all the way through to the end. The president's going to win that case because that makes sense for him to win. But I want to remind you, the president has lots of other authorities. He has 232s, he has 301s, he has 338s, he has a whole variety, 112, 122. He's got all sorts of other powers. And tariffs are going to be part of this administration going forward, but I don't think they're going to be necessary because the president's going to win the IEEPA case in front of the Supreme Court.
That was the U.S. Commerce Secretary Howard Lutnick there. And turning to more corporate news this morning as well, because Ray Dalio says the multi-strategy model that's taken Wall Street by storm is unlikely to last. Dalio says the siloed approach makes it harder to build meaningful relationships, hurting employee continuity and competitiveness. Here's some of what he told Bloomberg's Odd Lots podcast.
I think it's not going to last. There's different ways to play the game. That's a totally valid way to play the game. Maybe it's a totally fine way for the investment management, but it's not a fine way for building a 50-year-old. I did this. I built a 50-year-old organization.
Apple shares gained after the tech giant confirmed a reshuffle in its sales division. Sources earlier told Bloomberg the iPhone maker has eliminated dozens of sales roles in a bid to streamline the way it offers products to businesses. The affected positions include account managers and staff who operate Apple's briefing centers and product demonstrations. Google's parent Alphabet rose while Nvidia fell in late trading. This on reports that Meta is in talks to spend billions of dollars on the search giant's AI chips. The information says Meta plans to use Google's tensor processing units, or TPUs, in data centers in 2027. An agreement would help establish TPUs as an alternative to Nvidia's AI chips.
Yeah, let's start things off with the tech space. We woke up to, again, another resurgence in Mag 7. In this case, of course, it was really Microsoft, Alphabet rather, that really led the lines. And you're looking at some of the related names here in the Asia Pacific, and suffice to say, I think they're doing well in the session today. That's also to say when you look at the other side to this, which we'll talk about later on as well, right? So in the case of Kai-Fu Lee, who came on shows a few days back and said, the model in the U.S. is one where it's almost, if not winner takes all on AI. So it's OpenAI. Is it Gemini better than OpenAI? And is that why SoftBank is taking the back seat on that narrative? I guess we can get into that later on. But suffice to say, this is one side of that literal equation there. Gold stocks, fairly straightforward. Big rally in gold overnight. And the equity complex as a second derivative, playing a bit of catch-up there. We're up about 2 to 3% there. RoboSense shares are up. We were up as much as 5. Let's call 4.8% there. The company said it will partner with Didi, the autonomous driving unit there of the company, to develop next-gen robotaxi vehicles. We talked about this in the earlier segment. As far as robotaxis are concerned, we're better by 4% on that stock there. But yeah, that goes into some earnings are coming through today, and some of them are in the EV space too, the car space there.
Yeah, well, Pony's going to be the big one to watch because we had WeRide narrowing its losses in the latest reporting period. Still with Autos Neo, of course, you can see there's a consumer theme with Chow Tai Fook, Vitus Soy, Win Macau, but the big one, Alibaba numbers, and what are we going to see in terms of cloud revenue? Welcome back. You're watching The China Show, and we're taking a look at the Hang Seng half an hour into the session. So the gains that we had at the start of the week, they're extending, and there's a lot of positive themes. I think it's sort of, again, what we had overnight or yesterday in the session. It's the story around the Fed, these expectations that, well, it's not even it's becoming the base case, really. We're going to see a cut in December. But then adding to that is the story around tech as well. Yeah,
and those two things are right. We had an AI bubble concern about a week and a half back. In fact, like Friday going into the weekend. But those two things have somewhat changed for the better if you're long these markets, and have in fact come together to give us gains we're seeing across the region today. In fact, just flip the page, please. The iteration of that across greater Chinese markets is an earnings story, and it will probably depend what Alibaba says about their capex spend and AI. If that story is to extend further, if we're able to execute on this, Winnie Wu from BofA, in fact, had a very good. She laid out the likely path for Asian markets next year in the event U.S. tech implodes, corrects next year. And that might be something, you get that right. It's almost like you get the dollar story right, you get half the equation right. But yes, we'll try and play it out for you later on. Bilibili, Baidu, Xiaomi are all better today. And just speaking of the Asia side of that, you have the Nikkei coming back online, Kospi, Korea. U.S. futures are somewhat to the downside. I believe we have some breaking news right now out of Kyoto. This telephone conversation that we talked about earlier, following another telephone conversation overnight, which we'll get into later on. But very briefly, a look at the decliners. It's not all good, despite the perception of me. I'm not all good. Not perfect, but there we go. Some of the big names on your screens, like Hello Kitty. You have SoftBank, of course, on the back of maybe the Alphabet story, but yes, some declines here across some big names here. Bill, yeah.
Yeah, we'll get back to that breaking line because it has been nearly 3 weeks now since the Japanese Prime Minister commented on a possible Taiwan contingency in Parliament, and we're continuing to see that fallout, essentially. And it's now reached the leaders of Japan and the US, because what local media Kyoto is saying is that the Japanese Prime Minister Takaichi has held a telephone conversation with President Trump. That's according to government officials, and they're reporting as well. But the two appear to have discussed future responses following the phone call, of course, overnight, that surprise call that we woke up to this morning in Asia, but between the leaders of the US and China on the 24th. So essentially, this call now between Tokyo and Washington is following the call between Washington and China that we had overnight as well. So, yes, that is the latest we've got from local media there.
Yeah, and you know what? So this goes into, we forgot to mention this is the third market theme today. So we were looking at, obviously, the earnings story and the tech story. There's the Fed, there's the geopolitical conversation, which seems to be on better footing this morning when you look at the phone call there. But this might also be sort of the prism we need to look at the Japan-China spats in a greater context of the broader conversations between Beijing and also as far as Washington goes, and you look at the separate statements, right? And I think one statement did include that Taiwan was brought up. The other statement did not include, of course, the topic of Taiwan. Let's get into things. Min Lo, our China correspondent, is here with us to maybe let's start off with that phone call overnight between the two presidents.
Yeah, I mean, there are a few things to note. One is the timing, obviously, is not a coincidence. But the other thing is who initiated the phone call. That's not very clear from the Chinese readout.
That's a good question.
And there has been some reports, I believe Wall Street Journal reporting based on sources that it was China that initiated it. If that is true, it's quite a rare overture by China. And timing, it's not a coincidence that we just came off this frenzied meetings over the weekend to try to iron out this peace deal between Ukraine and Russia. And then soon after that, you have this Trump-Xi phone call, which the U.S. version says it was all about fentanyl, it was about soybeans, but the Chinese version said it was about Ukraine and Taiwan. And there has been many analysts drawing parallels between the Ukraine war and what U.S. would do in the event of an attack on Taiwan, right? And China is often of the view that the U.S. and its allies have a double standard, that they are, helping to support Ukraine and ensure its sovereignty, but then infringing on China's sovereignty on this front. So perhaps this is a call, and it was explicitly mentioned as well on the Xinhua readout that President Xi was highlighting in particular that reunification with Taiwan is going to be key for the post-war order. And also dragging out all the World War II context, saying that U.S. and China had fought shoulder to shoulder against militarism and Nazism against Germany and Japan, and it's so important to maintain that order, they say.
It's very interesting you bring up who initiated that call, because we've just seen the Japanese Prime Minister Takaichi speaking with reporters in Japan, and she's saying that the call that happened between Tokyo and Washington was at the request of President Trump's team, and also that in that, Takaichi says Trump briefed her about that phone call with China's Xi. But also just talk to us about this context here, how the spat between China and Japan is now involved to also encompass the U.S.
Yeah, obviously this is in some ways perhaps China also using this as a test of just how much support U.S. is willing to give to Japan as its ally, right? Because we know that Japanese officials had said that they want to deepen ties with the U.S. They have been, according to China, the rising defense budget, the development of offensive weapons, these are all signs of Japan's growing militarism, which is why China is so upset. And we are now a couple of weeks into that spat, and we do have fresh data now of flight cancellations because of China's travel advisory, and we are looking at upwards of 20% or so flight cancellations. There are some 12 routes where all flights are being cancelled between selected Chinese cities and Japanese cities as well. So China has been, in recent weeks, really been engaged on this war of words, right? They submitted a letter to the UN, which was an action that I guess you can see it as trying to seek support from the rest of the world, from the global south, to really make clear China's stance and a warning to the rest of the world, not just to Japan, but to the US and other democracies, that any, attempt to intervene militarily on Taiwan is going to be interpreted as an act of aggression by China, which will then justify their legal, their use of self-defense to defend their sovereignty.
Yeah, and just another line coming out as well, Min is that Takaichi is saying that President Trump says to call him anytime, so obviously leaving that door open. But that was our China correspondent, Min Lo, there with the latest on this. And let's talk about, I guess, the market implications, because so far you were just saying there it is the third element, but at the same time it isn't an element that's really been having much of a bearing so far. You could see the markets have been very focused on the tech story. They've been very focused on the Fed. I guess what would be the tipping point for this to turn into something that could actually affect more of the equity picture? But let's bring in our Bloomberg senior editor, Catherine Nye, who joins us this morning in Hong Kong. And Catherine, I'm interested for your views on this ongoing diplomatic feud. Of course, it's been 3 weeks now, but are there any sort of implications or assets that you're watching in particular for implications?
Right. I mean, I think the biggest one would probably be both the Japanese consumer companies, right? This is kind of the big one that if Japan and Chinese tensions get worse, that the likes of companies like Shiseido are at risk, because you end up, a lot of the buyers of these Japanese companies and these Japanese products are the consumer side. But I mean, as a whole, like you say, I think right now people are really playing off these macro factors. They're looking at, Fed cuts. They're looking at, U.S. data that's going to come soon. They're looking at what the valuations and what the run looks like in the future for these tech companies that has had quite a tumble in the last recent weeks. And we're seeing some of that recovery as people are kind of dipping their toes back in the market and figuring out what the best trades are.
Yeah, and that brings to mind then people talk about a bubble in the U.S., and I think, our guest earlier on, Winnie Wu, out of BofA, basically said when you talk about a bubble, we have to distinguish, of course, between the basket in the U.S. and where you are in China, where we're trading still, above the historical mean in China, but still much, much closer to the mean than we are in the U.S. Catherine, how do these earnings from Alibaba, which are due out today, how will that affect investors' views here on the runway for Chinese tech ahead?
Yeah, I'm always surprised, and I guess it's always interesting when people talk about sectors being bubbles, and it's a question that we've asked to many people always, right? Whether we're in a bubble, because the tech stocks have had such a run. I mean, the stock markets just around the world are at such high levels and trading at such high valuations. I think that Alibaba really kind of ground us a little bit. I mean, I think the expectations here is that, the growth isn't going to be that great. There's some areas in terms of margin pressures, and people really want to know how much Alibaba is going to be spending on cloud and on their AI to continue to sort of take advantage of this trend and to particularly sort of fend off rivals. I think that there's a lot of optimism this week, given that their revamped new AI tool has hit 10 million downloads. I mean, that was quite a thing, and there's obviously lots of optimism. So I think the key focus here as we get earnings tonight will just be how much they're willing to spend to continue this run. Given just the rally, I mean, investors seem to be still very generous in terms of their views of this company, especially with these margin pressures.
And Catherine, final question for you: how much has the expectations, or rising expectations, or almost fully priced expectations of a Fed cut in December, how has that helped risk sentiment today?
Yeah. I mean, you can just see it, the full screen of green, right? Everything is trading in the green. Everything is just so buoyant. I mean, I will say that it feels kind of every day seems to be such a varying and differing picture. I mean, there are a couple of days where people are worried about valuations, and a couple of days where people are thinking Fed cuts are going to come. I think that traders are trying to be really selective right now, because there's just so much there's so much news in this short period of time. Everybody is kind of hoping for this. So I think there's already been a lot of optimism already priced into it. But who knows? We might see another worry about lofty valuations overnight and buy some opportunity for another dip buying.
That was our Bloomberg senior editor, Catherine Nye, there in Hong Kong. Thanks for joining us. And as we've been discussing over the last few minutes, these lines and the press briefing that the Japanese Prime Minister Sanae Takaichi has just held following a phone conversation earlier today with the US President Trump. The Takaichi says was at his request. Now, some of the readout from this conversation that we're getting from Takaichi, she's saying that Trump briefed her about the phone call with President Xi. This happened on the 24th, yesterday, of course, but something we woke up to this morning in Asia. Also, that the US and Japan, according to Takaichi, reaffirmed or affirmed their close cooperation between those two countries. And Takaichi saying as well that not only did President Trump request this call, but also that he left the door open to continued conversations and said he's available anytime. So we'll get more details on this developing story ahead. This is Bloomberg.
Welcome back. You're watching the China Show. So you're looking at two things on your screens. One is this increased probability of a cuts around the Fed in December. This is Fed Fund Futures. You look at swaps, giving you slightly more at 85%. If you look at that specific metric, we're tying this together with the rally we're seeing in gold prices overnight. That's a two-day look. We're back to about 41.35. That's down to what we're seeing as far as the Fed conversation goes. If I could also ask my producers to scroll maybe a little bit on the script just to take us through a little bit further down. There we go. So gold has obviously had a fantastic year, suffice to say. I think it should be the best year going back a couple of decades, depending on which, if you adjust for inflation, that sort of thing. But suffice to say, it's been a fantastic year for gold. Does this continue, or do you have to look beyond the gold complex within the commodity space for perhaps better returns going into next year? Dominic Schnider, Head of Global Commodities and Forex at UBS Global Wealth Management, CIO, is here with us on set. Good morning.
Good morning.
Why don't we start there? We'll talk about golds, and maybe we can broaden the view beyond that. But what's the base case expectation around gold for next year?
I would say the base case remains that gold prices are well bid. I mean, we do see central bank demand being extremely robust. Even the data that we got out of October point to a very robust backdrop. So we can think about 1,000 tons of purchases on an annual basis. Maybe that's a little bit on the higher side, but in that magnitude. And I think investors in general are still worried about that longer-term end game with regards to deficit. I mean, who's going to rein in on deficit? Nobody. And I think ultimately that might lead to financial repression. So I think investment demand remains robust. That means prices should go higher. But should we target double-digit, some of the returns we have seen this year? Probably that's not warranted.
How do we know central bank buying continues? What degree of confidence can we attach to that trend? And why do you think that's happening?
Well, everything started with the war between Russia and Ukraine, and I think some of these developments where central bank felt that, longer term, not just holding dollar is richly valued, you want to a little bit diversify. These trends tend to be a little bit longer lasting, so that's just not 1 year. I think it's fair to see that could continue. Do we have a lot of confidence? No. I think we need to see every quarter how the development is, and if there is a little bit of a step change in central bank purchases. But for the time being, it does look robust. And with the uncertainty I mentioned before, I think prices can still gravitate higher. So as a diversifier, as a hedge, absolutely in a portfolio if you have this affinity towards real asset. But again, I want to come back to a little bit thinking, you can't just always extrapolated these kind of returns that we had. So you should rein in on your return expectations. I think 4,500, I think, is already generous. We do see things leveling off there to 4,300.
You did say in the ad break, talking to us about thinking beyond gold as well, but what do you then go toward, or what's standing out to you?
So I think there's two areas and you can think about. I mean, the world in equity is quite expensive, isn't it? I mean, we all talk about equities and credit, look at the credit spreads. There are places in the commodity landscape that is actually quite cheap. Oil is cheap. Look at it, how it trades in real term. I think it's almost dirt cheap, I would say. So I think that's something to look at. You can say, well, it's a reason. We have plenty of supply. But look into the second half of next year. I know that's looking very far out, maybe around two corners, but incremental supply should come down. And I think that warrants a little bit of a higher price. That's number one. Two, the grain price is trading at costs. La Nina is building, so there is some problem in the southern hemisphere. And I think some of these risk premiums are not visible. So I do have some sectors subsectors that can actually do well next year, just from a valuation point of view. And not much needs to happen. Positioning is short on the grains. That can flip very, very quickly. And then, believe it or not, we do think that into the second part of next year, we're going to get the growth acceleration at some point. All that stimulus, all that rate cuts will find its way a little bit into better growth. And that's why I want to have some exposure to copper, some of the industrials.
Yeah, talk about copper a little bit further. That rally stalled at about 11,000. We come down, obviously, from that. And you also have some supply issues there still with the big mines.
Yeah, I think the thing is, I mean, first of all, you do have a powerful supply story, more structurally. I mean, we haven't seen all that expectation not come to fruition. So what if suddenly supply growth is up 2% next year and demand does accelerate a little bit more? So suddenly the deficit is not just 400,000 tons, but 500,000. So I think there's a deficit building. There's also a little bit the problem that we have inventory in the US, but not in the rest of the world. And so there's a little bit of a mismatch on that part. I think that adds to the notion that prices probably in the rest of the world needs to be on the stronger side. So I would look at 13,000 thereabout on the copper side. I mean, it's nothing exploding away, but just simply people realizing that's the metal we need to transition.
What's the appropriate allocation then? Because you're saying other asset classes look expensive and you're still bullish on a number of different commodities going into next year. How much money should people actually be putting into them?
So in our strategic asset allocation, we have no commodities because historically has not really delivered on the returns, given the volatility that we have seen. So if you think about now allocating to commodities more broadly, do it in a tactical way, and that's probably between 1% to 3%. I think that would be a normal, depending on your tracking error, but basically that's the way I would look at in terms of broadening your exposure to different asset classes.
I mean, speaking of, and I was hoping to take a step back. That's a good point you made on, despite the year that gold has had, everyone has told us it's still not a structural play; it's still a tactical trade. Did you guys talk about that this year? Was there a need to revisit that assumption that gold has gone beyond? Because that seems to be a structural story on gold, but it's not yet a structural allocation for investors. If you could just square that circle for us.
Well, I think the biggest challenge is still that gold obviously does not have any yield on the table. So when you make your 15-year capital markets assumption, it just can't perform as much as you would like, also versus the volatility of, let's say, 10 to 20%. So I think that's a more structural problem that gold has. I think we need to, when we think about gold has two hearts. Did you know that? Two hearts. It can be a currency, and I think that's what it trades right now. And in that world, we can really even trade higher as we think about 4,500. But if suddenly investment demand would shy away for whatever reason, and we have seen that in 2013, well, things fall quite rapidly. Then it's being looked at as a commodity. And I think that drawback is for a lot of asset allocation people a little bit of a concern, you know what I mean? So if that investment demand suddenly goes away, think about the central banks. I mean, close to 1,000 ton. If we go back to the run rates we had before, 500 plus, who's going to fill that? Do you think investment demand is going to do that? Probably not. Jewelry, not going to do it.
ETF flows, definitely not.
Not exactly. So I think then you find yourself suddenly materially lower, and we have seen that in the past, and then repeated all over again. So I think these are some of the factors that I think asset allocators still struggle to say, hey, there needs to be a big allocation. I would say we have it tactically, and I think served as well. On the other side, if you have an affinity for real asset, and you take history a little bit into consideration, starting point could be a 5%. And then depending on your portfolio, how it looks like, obviously you want to ski increase it or decrease. It also depends which reference currency you have. If you're a Swissy person, which is already a safe haven, the value of gold is reduced versus an Aussie or somebody in an emerging market, there's a greater added value.
You just sort of, I guess, hinted at some of the risks, even though you are, as you said, still expecting growth to pick up in the second half of next year. What's the issues, though, you see to that sort of thesis?
So first of all, the economy is better today than we thought. So if you would have asked me 6 months ago, or basically after April 1st, I would say, okay, we find ourselves in a lower growth environment. I think some of this issue may be not solved, postponed, so they might challenge us still in the first half of next year. On the tariff side, I think we need to take this into consideration, number one. Number two, we should not underestimate that actually real wage growth is decelerating. Look at the latest European data. I think it was somewhere sub 2%. That means real wage growth is negative. And I think even in the US, real wage growth is going to come down. So if that is the case, obviously the bulk of our activity is all about consumption. That's going to slow. So maybe we underestimate that effect on the economy next year. On the other side, we do have a powerful investment theme, which is AI, which keeps powering on. But this engine is very, I would say, in a very narrow segment. It's not broad-based. Maybe what we need is more rate cut. And if that comes in, then we do have a little bit of a broader story. So the Fed put is here, and I think other central banks can still cut, believe it or not.
Yeah.
All right, Dominic, thanks for joining us this morning.
You.
That was Dominic Schnider, the head of global commodities and Forex at UBS, Global Wealth Management, CIO. And leaving you here with a look, we are just about an hour into the session so far, and you're seeing stocks that are moving to the upside, but tech is very much the theme so far today. So we'll have more ahead. This is Bloomberg. Quick check on markets this morning, and it's very much a tech-led story today. We're seeing TSMC, for instance, climbing 2.5%, but we have seen, again, a lot of enthusiasm around this sector in the US overnight, including an after-hours trade, because we saw Alibaba, or Alphabet rather, gaining after the information reported that Meta may be spending or in talks to purchase its TPU chips. We'll get more details on that market story ahead. This is Bloomberg. It's 11:29 a.m. in Tokyo this morning. Japanese markets just about to go into their lunch break. A lot of the focus, of course, has been on this phone call between the leaders of the US and Japan just in the last few minutes, and we'll get more on that in just a moment. But in terms of the market story today, it's still that two-theme one. It's around the Fed and this expectation that we will get a cut come December. But then adding to that as well as optimism around the tech story, which isn't actually flowing across to every single stock, because I think if there's one that you point to this morning, it's SoftBank, not for the right reasons, but that stock is sliding today. And look, you can sort of, I guess, maybe draw some or inference, I guess, or infer exactly what is behind that. But SoftBank, we know, is sort of an open AI play. They're heavily involved in Project Stargate in the US. They've been investing in that company directly as well. It's one of their biggest privately held businesses in their Vision Fund portfolio. And the concern is what you got late trade today, which was the gains that we saw in Alphabet. They're looking possibly to ink up with Meta on a deal to sell their TPUs, so to sort of try and reduce that reliance on the Nvidia story. Is that, again, having a bearing on what we see for SoftBank? Because, of course, it's very much the standout to the downside, but for the tech theme today.
You know where the name SoftBank came from?
Ooh, tell me.
So I remember, was it 2016? So remember there was one of the stocks, the SoftBank Corp and SoftBank Telco, and they branched out and they listed the other ones. I went to Tokyo to cover this. So it's a bank for software. So that's how it started. That's it. So people used to go to the company to be able to purchase and have access to software. So it's called SoftBank. Do you know where Samsung came from?
No.
It means 3 stars in Korean.
And I mean, we think about 5 stars. Why 3?
I'm not Korean. I don't know.
Okay.
I don't know.
I feel like that's a factoid and a half we just got.
Yeah, there we go. So,
but I love those.
Yes,
both of those.
Yeah, we will. We'll keep you hanging on the 3 to 5 there. Okay, let's talk about this phone call. Well, the two phone calls. So we had one overnight. between Chinese President Xi Jinping, U.S. President Donald Trump. In the last 30 minutes or so, we have more information now on another phone call between the Japanese Prime Minister, Sanai Takaichi, and President Trump. Takaichi mentioned that Trump briefed her about that call that he had with Chinese President Xi Jinping. Let's bring in our economics and government reporter, Yoshiaki Nohara, in Tokyo for us. Yoshiaki, thank you for joining us in fairly last minute. Yeah, we needed to get your thoughts on this and just the details on this. Is it how significant is it that it appears, based on the comments from the Japanese side, that it was the White House that initiated, that asked to have this phone call take place today?
So it's a good sign that if it's, indeed it was initiated by the White House, because the worst thing for Japan is that, it will be left behind in terms of what's happening in terms of communication between the U.S. and China. But at least the Takaichi got a phone call from Trump. So that's a good sign, at least showing that she definitely got the attention and probably support from the Trump administration over this important evolving issue. So that is a good sign for Japanese government.
Then how does it also bolster the Japan team that's also trying to work through this issue for the last several weeks now, but with China over Taiwan?
Right. So the Japanese side has been pretty much playing the usual playbook, meaning that it's not engaging in the sort of a tit for tat, the retaliation measures, and just trying to let the situation calm down by giving it some space and time. And this morning's call, it didn't have much details in terms of what was discussed exactly. But the important point is that it has attention and support from the Trump administration, and that is working in favor of Japan, because it does need the U.S. support to try to navigate this situation, not just by itself, but with its allies.
Yoshiaki, what's the latest on the ground? How is the story being received this week there? I just want to get a sense of how that's evolved from a perception standpoint in Japan domestically.
Well, that's a really good question, David. One thing that I found it interesting was that how the public opinion polls have been supporting, majority of them supporting Takaichi's comments about Taiwan, which was a kind of a surprise that to me, given the past history of the and past based constitution here. So meaning that she's not losing any, support from the public by speaking her. Taking her stand on the Taiwan sensitive topic, but at the same time, she understands that she has to manage the situation so that it doesn't escalate and blow up in terms of giving damage to the economic side of this bilateral relationship. But so far, the public seems to be understanding why she said those things, and also not panicking about a lot of retaliations from the China so far, because it's not really, if you look at details of these, measures taken by China, they're not hard breaks on the economic activities. It's more of a warning and slowdown of the economic ties at this point.
Yoshiaki, thanks for joining us. As Dave said, really, as this story continues to develop this morning. That was our Bloomberg economics and government reporter, Yoshiaki Nohara, there in Tokyo. And coming up, we'll shift ahead to what is going to be a big market driver. It's Alibaba's earnings, of course, grappling with a price war in the food delivery space, but also looking at progress in its AI services. So can that actually continue to drive earnings potential? But our team from Bloomberg Intelligence is joining us next. This is Bloomberg. We're taking a look at Alibaba shares this morning. So we are climbing here for a second straight session. It is the big countdown to the numbers that are due out pre-market in the US. But taking a look as well here, you can see on the right-hand side, what we're expecting in terms of the share price move, and it could be quite a big swing, maybe not quite as high as what we see on historical average, but still a move of 6% in either direction. The big focus is definitely going to be coming down to what we see in terms of the cloud revenue growth, and many on the street are optimistic. Not everyone. So we'll get more with our team from Bloomberg Intelligence with us now. So you've got Robert Lee joining us here in Hong Kong in the studio, but also Catherine Lim, who's in Beijing today. But Robert, I think we can start with you because that big focus is going to be on the cloud side. And notably, Bloomberg Intelligence is a little bit more sanguine on the outlook for this, I would say.
Yeah, sanguine's a nice way to put it. I would say realistic. But again, you don't need to believe me. Go to the terminal on MADL and you can see the numbers that are expected on Alibaba's cloud business. So I think, as maybe I've mentioned before, their capex has increased in round terms from around 3 to 4 billion a couple of years ago in US dollars up to 15 to 16 billion this year and next financial year. So that's a substantial hike in capex. So you might ask, what sort of return do we expect? So their cloud business is going to generate around 2.5 billion profit in the coming year. That's an increase of only 600 million US dollars. So the return on investment is not particularly high. And the second thing is it's really depressing their free cash flow generation, which has gone from over $20 billion a year to around, again, with some rounding, around $3 billion this year. So it's depressing free cash flow, and it's not really generating a substantial incremental return or return on investment. These are hard numbers on the terminal. So I don't think it's up for debate.
And markets tend to be short-sighted, right? I mean, that's I guess the downside of being a public company. You're judged on a quarter-on-quarter basis, sometimes a semi-half year. But these are longer-term trends that arguably, the company's investing in. Have we just not waited enough for the numbers on the terminal to turn?
Yes, I think if you are a long-term bull on Alibaba, then the company is gunning for AGI, which is artificial general intelligence, a level of AI that has a human-like level of intelligence. But I think if you look at the academic literature, if you even listen to, I can name at least 2 Nobel Prize winners, including Sir Roger Penrose, they don't think AGI is achievable on the current generation of models. So we need a significant technological breakthrough, which may or may not happen. So this massive capex splurge that Alibaba is putting through at the moment is trying to achieve AGI, yet the weight of academic opinion says that won't be achievable. So again, you've got this issue at the moment where they're spending heavily on capex. It's depressing free cash flow. There is some incremental revenue coming through, and just to give a balanced view, I think their cloud revenue numbers are really going to catch the headlines tonight. The growth is going to be high 20s or maybe even low 30s. So that's good. But as I said, the incremental profit is not really coming through, and you've got this massive drain on free cash flow.
Yeah, and Catherine, I'll bring you in here because, undisputably, what else is draining the cash flow or free cash flow is the spending that we see in terms of the e-commerce wars for food delivery, quick commerce as well. What sort of bearing do you think that will have on the bottom line?
Right. You're right, Annabelle. The company is investing, and this is the phase that Alibaba is in right now, and they have been upfront about it. They are looking to actually create the foundation for the longer-term growth, and this is coming through for their commerce business right now, because right now we're talking about not just e-commerce, but as well as the quick commerce, to which you will see that coming through in the form of stronger revenue growth for their China e-commerce group. And this is a new group that a company has actually created together. And that is probably also going to get the market excited that, they are able to actually grab some market share gain. But the caveat really here is that they have thrown in a lot of subsidies. We have seen that, and that came through over the Singles Day festival as well. So the big question right here really is that, how long will all of these subsidies last, and will it continue in 2026?
I'm interested as well in the way that you're thinking about AI because, as Robert was saying, they've got this huge spend on AI, and you're not really seeing it back in terms of the ROI yet. But in the last hour, we were speaking with Luz Ding, who's from the Bloomberg team, reporting team, but talking about how AI is being increasingly integrated across the different e-commerce divisions in Alibaba, and instead of asking people to maybe pay a subscription for QN, you might be able to see better returns in other parts of the business. I mean, how closely are you watching that?
Right. In terms of the returns from the investment itself, some of it is actually back end. So we wouldn't be able to actually see it that quickly. And one of the key things to actually take note on is that, there's a lot of algorithms that's actually happening, and they're actually pushing, for instance, more products to consumers. Let's not forget AMAP. AMAP is also a very powerful app that has actually integrated, the technology that Alibaba has actually pulled together to try and now give recommendations on top of the big location services that the company has actually surpassed Baidu for a while right now, when it comes to that. So all of this what is it going to really do is that it's going to make users just more loyal, more sticky to Alibaba app, and really that is a big plus. Question, of course, is are they able to actually monetize better some of these services and stickiness itself? I think time will really tell right here. And again, I will stress that Alibaba has emphasized on many occasions that they are in the investment phase. And I think it is the duration right now that I am looking out for tonight when they actually reports.
The food delivery, the new one from JD.com, Catherine, and obviously Alibaba is reporting today, Meituan is reporting later this week. Any changes to that specific part of those businesses for those two because of what JD.com has obviously thrown its hat in the ring here?
Yeah, I think, David, with the measures that we've actually seen coming from JD.com, I think it is a clear sign that going into 2026, we're going to see the competition still staying quite intense for everyone. You're going to get new services, new consumption scenarios, as we call it, within the sectors itself to try and stimulate, spending sentiment out there. So, competition isn't really going to go away, which is why, it is key that, they get more of that loyal customers. I'm quite sure that, the 88 VIP members, which are the paid members, within the Alibaba system itself is going to reach a record high when they actually report, tonight and also, after the Singles Day as well. So some of these things, David, it's really the seeds that they are planting for the longer term growth.
Robert, we can do a bit of a pivot now just to the broader tech complex because, yes, we've seen a very strong session overnight for tech stocks generally, but one of the interesting moves was after hours with Alphabet and this deal possibly reporting from the information, but maybe Meta's looking to use their TPU chips. And I think that speaks to a broader theme. There's a lot of companies out there, hyperscalers more, that are looking to decrease their reliance on Nvidia. Does that become a bigger theme, do you think, going into next year? And does it also test that case of the US leadership, I guess, in this space as well?
Okay, well, absolutely, we're going to see more of this into next year because Nvidia, simply put, is a monopoly at the moment. More by accident than design. It had an approximate 10-year technological lead. It's been investing for far longer than anybody else, and therefore it's got the market to itself at the moment. It's been generating, I think, what economists would term supernormal profits. They're not sustainable at that level in the long term. So that's clearly going to attract competition, alternative suppliers, which is why you're seeing the likes of Meta or even Amazon, or even here in a China context, Baidu and others are designing their own chips, given the scarcity of supply and the fact that the market is solely dominated by one player. So absolutely, you're going to see more of that into next year. And in terms of the US versus China, I mean, is it a war, isn't it? I mean, I guess a word that I've learned over the last 18 months is bifurcation. China and the US are living in increasingly separate worlds, reflecting the geopolitical backdrop that we live in at the moment. So I think, Chinese tech is somewhat separate from the US. Which is winning? Does it really matter, or is that really relevant? I think China's approach is on a budget. It's a focus on low-cost, computationally efficient models, and really, as defined by the overriding government strategy known as A+, they're looking to proliferate and deploy AI in a meaningful way on a short-term view across their economy as a whole. So that stands to gain efficiency savings and productivity savings at a lower cost on a shorter time frame than their US peers are doing. So it's a very, very different approach. Effectively, what I'm saying is they're looking more at short-term wins, and they're doing it with smaller models and spending a fraction of what their US peers are in terms of CapEx spending.
I'm curious because people talk about this, you know, the competition prism, right? Who's winning the AI war? I might not be old enough to remember, but did anyone talk about who was going to win the internet back in the day, or was it because the U.S. was primarily the predominant tech? The reason I just frame it that way is you have two competing models, which looks to be they can coexist unless they're used against each other, and that's a whole different can of worms. But to the point that you always make, that we haven't seen the Chinese platforms monetize AI yet. Does a cheaper model, agnostic if they win or lose the war against the U.S., the AI battle against the U.S., does that help them achieve monetization quicker?
I think if there was one dominant player in China or the US that had some sustainable competitive edge, you know, it had there was some unique aspect to its technology, a very strong barrier to entry. Absolutely. I mean, that's a classic internet model. You basically give it away for free, you build your user base, you build market dominance, and then you look to monetize later. But the problem in China, and I think the US to a greater extent as well, is all these companies are employing the same strategy. The big tech platforms are very cash-rich, so they can keep going. There's no sort of weak hands to fall by the wayside. And I think, as you've seen, the technical barriers to entry in AI are extremely low. The prime example being DeepSeek, a 200-person outfit which can seemingly come out of nowhere and disrupt the entire market as it did in January. So again, I'm not trivializing AI, but on the software side, it's not that difficult to do. There are more than 500 large language models in China at the moment with a relatively low level of product differentiation. So if you take all those factors into account, it's very, very difficult to build a sustainable competitive edge, and therefore very difficult to monetize. No wonder the vast majority of products in China are available for free. So we really need to see a consolidation and a shakeout in the industry to at least put it potentially on a more sustainable profit footing. But then the last thing I just add is, where are the killer apps? You know, where are the killer apps? AI has clearly proved itself as a useful technology for driving cost and efficiency savings, but I would argue it's not really transformative. Now, maybe a graduate or someone at college may disagree at the moment because they seem to, you know, it's really useful for their studies and everything else. But I think for the average person, the average business, again, I'm not denying it has its uses, but I really don't think it's as transformative as some of the tech bros have argued. You know, where's the cure for cancer? I think it was Sam Altman who claimed that. You know, OpenAI's current monetization approach is actually on the adult entertainment industry. You know, I think it's really failed to live up to a lot of the hype, and I use that term deliberately. Again, it's a useful productivity tool and efficiency tool, but it is incredibly expensive to build out the infrastructure, and it's also very expensive to operate. So the economics of AI don't, from where I'm sitting at the moment, make a huge amount of sense. Again, OpenAI is going to generate 12 billion revenue this year, but based on our analysis, they're going to lose 40 to 50 billion. So, you know, it remains to be proven. I think that's the most generous conclusion I can give there.
Okay. Looks like we pushed the bottom there with Robert. Okay. Sounds like a podcast waiting to happen. Robert, thank you so much. Fantastic. That was our team, Robert Lee here in Hong Kong, Catherine Lim in Beijing for us. Subscribers can turn to your terminal for upcoming coverage, the results coming through Alibaba. TLI Vigo is the function you run for context there going into the next couple of hours or so. Check it out. This is The China Show. Right, welcome back. Just before we go, our last look at these markets here. We're doing quite well across the benchmarks. At one point, though, it did seem to be losing momentum in the last, let's call it 30 minutes or so since that point in time. We've tacked on these gains. We're up 2% now on the Hang Seng Tech Index, so we're doing quite well. Very quick look at the top gainers underneath the hood. And yeah, you can have a look at these big tech names here on your screens there, Belle.
Yeah, well, Xiaomi's really standing out here, but it's also Alibaba.
Your favorite.
Well, it is my favorite, actually. Hang on, you're not supposed to do that. It's like having a favorite kid.
Your favorite.
But yes, I do like that company. Alibaba as well, another name that I like to track. And of course, the earnings, we just had a roundtable there, but going to be very closely tracked as well, given we've got those earnings coming up. Baidu, I mean, I think there's just a general optimism around the tech space, and certainly Kuaishou as well, catching a bid today. But that's it from the China show. We're going to have Insight with Haslinder Amin next. Stay with us.